Hello friends, today we're going to talk about one of the most popular tools in technical analysis. It's the MACD indicator. You've probably heard this name before, but might not fully understand how it works. Don't worry, together we'll break it all down in simple terms using real examples. But first, I'd like to share a bit of history about this indicator. It was created in the late 1970s by Gerald Appel, who wasn't a billionaire or a Wall Street legend, but an ordinary person. He was passionate about mathematics, observed the markets and tried to find a way to simplify the understanding of the price movements. Gerald experimented with combinations of moving averages and determined the crossover of two moving averages with different periods could signal a trend change. And that's how the MACD was born, a tool that helps see when the market might be changing direction. The essence of the indicator lies in comparing two moving averages, where one reacts quickly, almost to every fluctuation, and the other, in turn, is slower and shows the general trend. To make it clearer, let's imagine a race, for example. There's a sports car, light, fast, but unstable. And there's an SUV, heavy, slow, but steady. So, on the straight section, the Jeep might win because it can gain high speed due to a big engine. But on a track with many turns, the lightweight car will come out ahead, handling the maneuvers better. Thus, one of the cars will constantly pull ahead and the race leader will change. It's the same with charts. The very moment one line overtakes, the other often signals that the trend may start to change. Let's see how this looks in practice. I suggest we try opening a few trades using three different indicators, one of which, of course, will be the MACD. Before we begin, I want to warn my viewers in advance that no indicator guarantees profitable trade 100% of the time. Great. Let's start with our first analysis tool. We choose the EMA indicator. A moving average, essentially, it's the line that smooths out price movement and shows the overall market trend. On the chart of the AUD/CAD OTC asset, we notice a situation where the price, after a smooth decline, begins to gradually slow down and prepare for a reversal. This moment is well confirmed by the interaction of two lines, the 20 EMA in yellow and the 50 EMA in blue. When the faster line, 20 EMA, crosses the slower one, which is the 50 EMA, from the below upwards, it's often interpreted as a signal of possible growth. In the end, the price movement indeed justifies the expectations. The position closed positively. Now we move to the RSI indicator, the Relative Strength Index. It's important to understand the indicator works best when the price quickly approaches these levels, but doesn't linger there too long. If the signal lingers in one zone, the probability of it playing out decreases. In our example, we analyzed the USD IDR OTC asset. Here the price breaks over the 70 level, showing that the market is overheated upwards and there is a probability of a downward correction. For a trader, this is the very moment to act. We open at $50 trade and the price indeed moves downwards. In the end, the position closes in a profit. This example shows how the RSI indicator helps to notice overbought conditions in time, not against the exhausted market. For the third trade, we use the MACD indicator. As we found out earlier, its task is to show the balance power between buyers and sellers. It's based on moving averages and allows you to catch moments of trend reversal. On the chart of the same USD IDR asset, the MACD lines begin to cross downwards. The green and red lines form characteristic movement, which is often interpreted as a signal for decline. For a trader, this is good confirmation and market is ready to move down. Based on the analysis, a $50 short trade is opened and once again, the price movement justifies the expectations. The position closes positively. These three examples clearly show that indicators help you better navigate the market situation. EMA indicates the general direction, RSI shows the state of the overbought, and the MACD helps see the reversal in time. But the key point is the ability to correctly interpret signals and consider overall context. No tool works 100% accurate. Therefore, it is always important to practice on a demo account, combine different indicators and maintain discipline. Today, you learn about the origins of the MACD indicator and why it became one of the most popular tools in technical analysis. Remember, any market always involves risk, so use indicators as assistants that make your trading more conscious. Guys, I hope this video was useful for you, as we not only looked at the history and the theoretical part, but also broke down in practice how the most popular indicators work. To not miss the next video, you can subscribe to the channel. There you'll find many more interesting videos that are not only based on theory, but also on practice.